Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. The best time to own stocks is after painful corrections and when there's a lot of pessimism baked into the markets. Joining us to discuss, we have Spuds Powell, managing director at Kayne Anderson Rudnick. Spuds, it's great to see you as always. Welcome back to Trade Talks.
Thanks so much, Jill. Nice to see you too.
You got it. And you had mentioned to me that 2022 ranks as the second most difficult year to invest in your 30-year career. Why was that?
It was terrible. Worse, I think, than most people realize. What made last year so difficult was not only did equities suffer and have one of their worst years on record. The S&P 500 was down between 18 and 19%. Other indices are down quite a bit more than that. While that was happening, the fixed income markets were having literally their worst year ever. It was the first time ever that both stocks and bonds declined simultaneously by double digits. So there really wasn't anywhere to hide.
You also like when there's high levels of pessimism and fear, or, it's time to own stocks after painful corrections. Explain to us why that is.
Well, I've always said that one of the most common and worst mistakes investors make is the mistake of letting their emotions influence their judgment, particularly fear. And yet history's proven quite consistently that the best time to own stocks, and in many cases the best time to buy stocks, is when there are heightened levels of fear and a lot of pessimism. And when I reflect back over the last few months or few quarters, there have been a lot of reasons to be nervous and worried. So whether it's concerns about the Fed, concerns about China, concerns about banks, concerns about interest rates, a recession, the war in Ukraine, the debt ceiling limit, there's just been a lot of reason to worry. And at times like these, expectations are very low. And what a lot of people, I think, underestimate is you don't need lots of good news in order for equities to perform well. All you really need is news that's less bad than what's been priced into the markets. And so again, history's proven quite consistently that it's at times like these where there is a lot of pessimism and bad news baked into the markets that in many instances equities surprise on the upside.
Yeah, I mean, we're seeing that too certainly over the second quarter, where it seems to be there's less bad news. Earnings were better than had been expected. So you can see that reaction off of such pessimism coming into the quarter. When the Fed stops raising rates and there's more clarity on the macro, more clarity around policy, how do you think investors will react to that?
I think that's one of the key issues and has been for several months. When the equity markets sold off as badly as they did last year, and when the yield curve inverted, those were two very obvious signs that investors were predicting a recession sometime this year. So that bad news and that sort of downturn in the economy is already priced into the markets. What investors have been waiting for is the opportunity to see the light at the end of that tunnel. Every time the Fed raises rates, there's about a 6 to 12 month lag between when they raise interest rates and when it ultimately impacts consumer spending, consumer demand, and the broader economy. So every time the Fed raises rates, it just sort of delays the inevitable rebound following the expected downturn in the economy. Once the Fed communicates to investors that they're going to halt the presses on raising rates and potentially pause, which can't happen obviously until the Fed has a lot of confidence and conviction that inflation really has been tamed or is trending in a good direction. But at that point, when the Fed makes that sort of impression on investors will be able to look 6 to 9 to 12 months down the road and see the inevitable recovery in the economy. And I think when that day comes, the stock market will surprise folks on the upside.
So really the moral of the story for longer term investors, it sounds to me, is not let your emotions get in the way and recognize that there is a cyclicality to this.
That's right. And unfortunately, emotions tend to be very detrimental. And unfortunately, when investors let either greed or fear influence their judgment, it usually means that buy at the worst time, they sell at the worst time. And what most investors, I think, fail to realize is when the equity markets rally, they can rally very significantly and very suddenly and very quickly. And to the extent that you're sitting on the sidelines when that happens, perhaps because you made the mistake of getting panicky and cutting bait on the equity markets, not only do you kind of lock in those paper losses when you get out. But if you also miss out on what can be significant and sudden rebounds, that doesn't end well for most folks.
All right, Spuds, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
It's my pleasure, Jill. Nice to see you.